Hello, welcome back. So Apple is massively trending right now, as you can see here on our tool, both on stock tweets and Twitter. And this is because they had its earnings report, and the stock actually is up about 3% right now, I believe, after hours. And in this video, we're going to take a look at what caused that. Now remember, you can always become a Patreon and get access to this website, this tool in which you can analyze your stocks your own way pretty much and try your own stuff here with the help of our stock evaluation tool as well. Now, Apple has actually done a little bit better than expected here. And the same thing happened with Amazon. It's only Intel that has actually really been destroyed in this earnings season because they did terribly. But let's take a look at what Apple did. They beat on revenue and profit here, and they expect growth to accelerate despite the pockets of softness. So let's examine the exact details here. Okay, so let's see what they did. EPS of 120 versus 116, which is still down 8% year over year, but better than expected from analysts, as you can understand. And the revenue is also better than expected, 83 billion, although very close to what was expected. Now, iPhone revenue, as you will see, is up at about 40 billion over here, and services revenue slightly down a little bit, but still up 12% year over year, so that's looking pretty solid as well. 8.08 in terms of other products. Mac revenue, which is also kind of down here, but it's actually down as well from 10%, down 10% from year over year, and worse than what was estimated. So Macs seem to be lagging a little bit, and iPads, however, seem to be doing better, 7.22 billion versus 6.94, down 2% year over year, but still better than expected. Gross margin of 43.26%, which is actually surprising here. I expected the gross margins to go down, but it looks like they are better than what was estimated. That's pretty good. Now, Apple did not provide formal guidance for the quarter, and if they did and it was good, the stock price would definitely have climbed even more. Analysts expected the company to give fourth quarter guidance of 1.31 earnings per share and nearly 90 billion in sales here. They did say that they expect revenue to accelerate in the September quarter despite seeing some pockets of softness here. Now, of course, they do refer in COVID, they do refer in supply chains and softness in, I'm assuming, consumer. But Apple's revenue rose 2% during the year compared to 36% growth during the same period last year and over 8% growth in the March quarter. So you can see that there is a decline in terms of growth. However, there is still some growth, and you can understand that during this current epoch, this current era, it's tough for companies to grow because the cost of money is getting higher. Lockdowns, again, supply chains, all these things have contributed, inflation of course, have contributed to a dismal outlook for a lot of companies, really, including one of some of the behemoths like Apple is. And it may not be the worst quarters upcoming, so that we may be seeing some even more softness in the next few quarters, to use the same language that was used over here. Now, chip makers and other computer vendors have signaled that there is slowing demand for smartphones and PCs around the world as consumers grapple with recession fears and decades-high inflation. And that is probably one of the big reasons why Intel actually got destroyed earlier, and I've made a video about it. I will link to that in the description, actually at the end of this video, so you can actually watch that when you are done with this one. Now, Cook, the CEO, told CNBC that the company is seeing inflation but will continue to make investments. We do see inflation in our cost structure. We see it in things like logistics and wages and certain silicon components, and we are still hiring. That is interesting. They are still hiring, yet they are seeing the increase in wages as well. Because right now, you do see quite a steep increase in wages. The job market is still tight, and it's going to take some resources to grab the best talent around. And so you're going to be seeing some inflationary pressures put on wages as well. And silicon components, for example, as you'll see, is another thing that causes some higher, steeper prices here. Now, Apple's iPhone sales exceeded Wall Street expectations, and that's definitely one of the benchmarks for Apple's growth. So it's nice to see that. And demand still remains strong, as usual, pretty much with Apple here and its iPhone. Now, you will see that the services business was the fastest growing segment. Very nice to see, actually, because the services business has a very, very nice thing about it. It's based on subscriptions, for example, and as you see here, monthly subscriptions, payment fees, and things of that sort that are recurring, pretty much recurring models. And it's nice to see because it will keep growing potentially for the company. It's tough for a recurring model of as like a subscription, for example, to go down instead of like increase its output. And so you could expect this to be doing better and better, at least overall for the upcoming quarters or years, which is nice to see. And they grew over 12% during the quarter, which is fairly surprising actually. Although that is a decline from the 17% growth that they posted in the second quarter, it's still pretty nice to see that they are still growing in the segment again during this current climate, this current economy really. Now they do have 860 million current paid subscriptions, which includes anyone who subscribes to an app sold on the Apple App Store, in addition to products such as Apple Music and iCloud. So these kinds of consecutive payments is definitely some of the very, very important things for Apple if they can continue to achieve that. Mac sales were sort of consensus expectations and fell over 10%. That's an interesting one actually. Probably, due to supply constraints and the strong dollar, that does make a lot of sense actually, and maybe that will reverse in the upcoming years or so. I have to say that Macs, at least I always had a Mac for many, many years now. I really, really enjoy Macs, and I think they will come back strong eventually. Okay. So iPad declined 2% annually, but still beat on forecasts as we examined earlier. So they still did rather well over here. And they said, Apple, that is, that they spent over 28 billion on share buybacks and dividends during the quarter. Especially share buybacks is what I love to see, you know me. And so this is something that is really, really good for investors that have been investing in the company in the previous quarters or years, because now their stock is worth more. And so as a stockholder, I love seeing that the company is buying back shares. Now the gross margins exceeded the company's own forecasts. So that's another very interesting thing that I wouldn't expect, frankly. It's better than the expected gross margin, so it's 43.26 here. So that definitely has an effect on profitability, and more than likely at least. And so it's a really, really good metric that they are not really that suppressed in terms of gross margins here. Very good to see. Now, if we go back to our tool here, you can kind of see some stock news which give you some nice ideas here. This is one of the nice features of our stock news module. Apple faces lukewarm demand in China after quarterly revenue drop, is what analysts are saying here. And you will see that even as inflation bites, Apple and Amazon do beat, and Apple services revenues gain 12% as paid subscriptions top 860 million. So you can kind of get the titles here in a very nice and concise manner, which kind of helps quite a lot over here. Now, in terms of the price is the important thing, because right now we're going to be seeing the price of Apple growing, and it hasn't fallen a lot, like 14%, and it's up almost 3% right now. It may be up even more in the future when the market opens, pretty much in the next couple of days or so, maybe, or a week. And they are frankly really, really balancing themselves out, despite what has been happening in the overall markets that have been completely destroyed. Apple is holding up really, really strong here. And it's a problem for people who want to invest in it, because it has been expensive, more expensive than I would like. Not super expensive, but still more expensive than I would like. And we can always take a look at the estimates, which we have done in the past, but there are many things to like about this company. The P ratio and the price to free cash flow ratio have gotten down, and quite significantly from the previous years, which is nice to see. And outstanding shares, they are also buying back shares, which is another great thing to see for the company, and I'd love it as a shareholder. But what is the price to pay is the important thing, and this is where a stock evaluation tool will help us with that, will give us an estimate and a good idea of what to pay for the company. So let's take a little bit of a look and try to be a little bit conservative, stay somewhere in between. Still, the company's revenues seem to be growing relatively nicely here. Remember what we examined over here. Revenue was 83 billion versus 82, which was up 2% though year over year. That's 2% for the quarter though, as you can understand. And so you can maybe say that we're expecting maybe an 8% or a 10% in terms of the year, for example. So let's go with this one. Let's go with actually a little bit less, 7, 9, and 11 here, which is low for what the company has been doing. This is actually the lowest, and 11% is actually lower than their 5-year average. I just want to go low and see what we're getting. Well, then I can try maybe some slightly more aggressive expectations and see where we're getting with these ones. Now, the net income margin, again, their margins seem to be increasing for the company based on the margins that we examined earlier, that were the gross margins, but they do affect the net income margins for the most part, usually at least. And we will go in between. Let's go 22, 23, and 24. Still, we will not touch the 25 and 26 range. And the free cash flow margin, again, the company has been near 100%, maybe a little bit more. So we're gonna go, they're typically more than that. So I'm gonna go 100, 105, and 110, and 13% for the annual return here. So let's hit calculate, see what we're getting out of this one now. And when we do that, we see that our high estimates are sitting at 126. Now our current price is gonna be higher than this. Remember, we're up 3%, which means that we're at about 161, 162, maybe something of that sort eventually for our current price, or at least maybe closer to 160 potentially as well. We'll see what happens. But our high estimates with an 11% revenue growth are sitting at 126 bucks, which are a little bit more. It's a little bit more expensive than what we would like. Now, if we project that the revenue will spike, and let's just say that the company will achieve for the next 5 years something like 13, 17, 15, and 17 here, then we may as well see it in the green for the high ones. But the problem is that this kind of revenue growth is very, very aggressive, 17% for the next 5 years. I think that's gonna be a bit of a stretch here, especially when we saw 2% for the quarter. I don't expect the company to achieve this kind of growth. So it's still a little bit expensive, yet it's a great, great company. So we may be sitting at a point where it may be beneficial to at least consider a little bit of Apple. It's still expensive though. I'd like to get it at a cheaper price. Again, remember 162. So if we have a little bit of a slump in the markets and then it goes down maybe to 120 something or so, it may be an interesting one to add to a portfolio. Even though it's a little bit more expensive, I like the things that I'm seeing overall. The kind of growth that the company has been achieving is nice. And again, even though it's a little bit more expensive than I would like, their gross profit margin gets better, their net income margin likely is going to get better as well. They are doing very well overall. The dividend yield is low, but very, very secure here. So it is a company that it may be beneficial to hold for the long term. And if you are willing to pay maybe a little bit more just because you are getting something better as well, it may be interesting to buy the company near 120 potentially, something of that sort. It may not be a stretch at all, but 162 is a little bit more than I would like right now. So I think I will pass and just again be wary about potential opportunities, because Apple hasn't fallen at all, frankly speaking. Like 14%, it's probably going to be somewhere near 10% or something of that sort since its last 1 year high. So it's just not a steep enough decline for me to enter right now. I want to get it at a steeper decline, and I'm willing to wait a little bit. It will happen eventually at some point. I'm fairly sure there will be the time to buy this one. It has been a massive high flyer, so I want to wait for a steeper discount, which I feel will happen. Maybe not now, maybe not yet, but there will be an opportunity to get it at a better price, and at that opportunity I think I'm gonna load up quite a bit of Apple when that happens. But I hope that video was beneficial and useful and interesting to you. If it was, please leave a like and subscribe if you're not a subscriber already. And in the meantime, watch the other video that I made earlier and talked to you about. It's the one about Intel, which was a disaster. Their earnings were really bad. We'll see what will happen with this company. Maybe I'll grab some if it keeps going lower, especially if they cut down on the dividends. I'm actually willing to wait on that first, see what happens there. But it's an interesting one to take a look at the video, and so I'm leaving the description in this video so you can actually hop along after watching this one. Thanks for watching, and I'll see you in the very next one. Bye bye, guys.